following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
All right, and welcome back to Volatility Views, your weekly source for all things volatility related. My name is Mark Longo from the optionsinsider.com, as well as the old Options Insider Radio Network. And I am very pleased to say that I am being joined once again on the program following a very long hiatus by none other than my boon companion here on the show, returning from across the pond, one Don Schlesinger from Volex. Don, welcome back to the show. It has been too long.
Well, you can't imagine how happy I am to be back. Been to France many, many times. My wife's family background is French, but unfortunately this recent trip was not one for pleasure, but one to see her elderly father through a difficult operation after a fall that he took. So more family-oriented business, but I'm very happy to be back. And I managed to open Skype correctly and even remember how to get back on the show. So I hope too much rust won't be showing today.
That was going to be my question for you. You sure you remember how all of this works and what we're talking about here? Volatility. This isn't your blackjack show, you know.
Well, I got here, so with the first step, the first hurdle is overcome. We'll see how the rest goes.
We'll see how the rest goes. And speaking of the rest, Don and I will be joined shortly by another fantastic guest, David Palmer, the Volatility Portfolio Manager over there at Hudson Bay Capital. But first, Don and I are going to dive right into the Volatility Review.
It's time for the Volatility Review.
And welcome to the Volatility Review. This is, of course, the portion of the show where Don and I run down the week's worth of volatility action. And it seems like only a few days since we did the show last, because, of course, it was. We recorded the last show on Monday, but now we're back to our usual recording time. And it just feels more natural, Don, to be doing Vol Views here on a Friday afternoon as opposed to a Monday morning. It just doesn't seem right to do it on Monday.
At the end of the week where it belongs.
Yeah, exactly. Of course, today being a holiday, there isn't too much vol action to speak of today, and we did the show on Monday, so we have a bit of a truncated volatility review of a Tuesday through Thursday, but we did see some interesting action over this past week and into even the previous week, particularly from a S&P/VIX perspective. We saw, I think, the most interesting development for a lot of S&P and vol traders has been, we've talked numerous times on this show in the past about that term structure in the VIX futures and how just it has been bid almost out of all reason or proportion, and what some of the factors were that were going into bidding up some of these longer term futures and giving that contango that just such a steep skew, probably one of the steepest on record, and certainly a very bizarre trading scenario if you're looking for any sort of long-term volatility position that you're really paying a serious premium. And a lot of people were speculating, and we were speculating certainly on this show as well, as when that term structure would finally start to ease a little bit. And we saw some of that over this past week and even over the week before, where finally some of these futures are starting to come off a little bit and some of the front months starting to come up a little bit, to the point where we have I wouldn't call it completely reduced by any means. It still is very steep, but compared to where it was, let's say, a few weeks ago or even a month ago, the VIX futures skew has certainly come off quite a bit, or this VIX futures term structure, I should say, has certainly lessened to a significant degree. I think that's been probably the most interesting and dynamic development we've seen over the past week. Of course, VIX cash commensurately coming along with those VIX front month futures kind of rallying up a little bit given some of the sell-off we saw over the past week and some of the vol we saw. And also, interestingly enough, we didn't see what we traditionally see going into today, which is a holiday and a long holiday weekend. Don, you certainly know this, and I certainly know this from being on the floor. If you're in any way any sort of liquidity provider, you're champing at the bit to have any chance to sell that premium, to sell that weekend going into a long holiday weekend. So they'll start selling the long holiday weekend on a Wednesday usually, or maybe a Thursday if it's an active week. But certainly by Thursday afternoon, you're seeing most of that weekend has already come out. And yet yesterday, what we saw in a lot of volatility products and also just in a lot of general single name option products and index products is that the vol stayed in. The weekend pretty much stayed in. And so that is an interesting development in and of itself, where we're starting to see market makers become hesitant to take that weekend out. That usually, if you're a savvy trader, you can come in on Friday or on Thursday afternoon before a long weekend and actually scoop some decent deals where essentially you're getting a free weekend's worth of hedging or exposure because that weekend has already been taken out of the product. And sometimes
we had an unusual situation this morning that I'm sure listeners are aware of. This being Good Friday, the markets, at least the equity markets, were closed, and yet they had that window of opportunity where the futures would trade for a short time this morning on the heels of the jobs report that was going to be released, and the federal government isn't closed. And so we had this unusual situation where the stock market can't tell the federal government what to do, nor vice versa. And so we had this rather important number come out, which certainly has been known to move markets, and yet the markets were closed. So I think the concept of, draining the premium out of options or perhaps some of the VIX products in light of this rather unusual situation where any kind of an untoward number could have spooked the market, as in fact it actually did this morning, led to a little bit of caution in taking too much out early because of this rather unusual event.
Yes, this was a rather bizarre set of events we saw unfolding this morning, a major number occurring when the market is essentially closed. So I agree, that probably did cause a lot of market makers to keep their powder dry and not aggressively lower their bids going into what is essentially not a one-off, but certainly a very, very rare occurrence that you have a significant market moving event on a day when you really can't trade in and out of it. So except for, like you said, that brief moment in the morning when the futures are trading.
The other comment that I would make, going back to your first part of the discussion of the contango and how pronounced it was, is that I've said this many times. It's my personal belief. I think most people would agree with me, and that is the idea of where the farther out months trade with respect to the near term is really a function of two different elements. One of them is the absolute level of where volatility is at the moment, where it would be expected that longer-term volatility would regress to the mean. So if the current levels of volatility, for example, were extremely high, which is not the case, we might expect even backwardation, or certainly not any type of steep contango, because people would think you can't sustain these high levels out 5, 6, 9 months. But the very opposite is true at the present, and was even more so a couple of weeks ago. And that was that we were extremely low levels, both of realized actual volatility and the implied volatility as measured by the VIX. And when that happens, apart from any forecast as to where the market will actually go in terms of price level, you have volatility expectation to regress to a mean, which is certainly somewhat higher than the levels that we've been seeing now. So that would be your first element towards contributing to rather steep contango, namely that, looking out 6-9 months, people are thinking we're just not going to be at these low levels forever. Now, that can get compounded or exacerbated, if you will, if on top of that there's any kind of skittishness or nervousness about the market as a whole and what levels we're at, and whether we've had a tremendous first quarter and, a terrific bull run for a while, and people getting nervous about actual price level. Because if there is a further expectation that prices may drop, and that the market may drop, we all know the connection, inverse correlation between implied volatilities and market direction. So now you have the further potential for people pricing into those back month VIX futures, the concept that we may have a sell-off in the market, and if that takes place, irrespective or regardless of the first point about regressing to the mean, we're certainly going to have an increase in implied volatility if there's a sharp sell-off in the market. I think it was the confluence of these two ideas that created that very, very steep contango. And, once you establish that type of thing, it takes a little while for it to work itself out, and we're starting to see the beginnings of that now.
Yes, the exact root cause of that contango has been a very contentious issue for quite a while now. And there's been a lot of people weighing in on a number of sides. And of course, everything you said just now is completely correct. And then toss into that volatile mix this interesting universe we've seen spring up now of structured volatility products and all these other structured products in the vol universe, and how so many of these products are very, very heavily short volatility, particularly some of these levered products. And so these are regular and heavy buyers of the long-term vol, and many of these have also contributed to this extremely steep contango we've seen. So it's just been a perfect storm, and to use a very overly used cliche, a perfect storm of volatility buying in some of those longer-term futures that has really just created this bizarre situation we've seen. And like we said, that their demand in those products for vol is not going to go away. So it'll be interesting to see how much this term structure can actually lessen and how much it can come in before these players come in, whether they're annuities or whatever the case may be, and start steepening it again or start bidding up this term structure again. It's just an interesting scenario to watch unfold, and it really is a relatively unique time right now because we've never had this mix of products and situations all at play at the same time. So very interesting to watch unfold. And speaking of watching things unfold, Don, what have you been watching out in the land of NASDAQ and NASDAQ volatility? I know you've been a little busy over there having some baguettes, but
it's true. I had my daily baguette. That you can't pass up.
So aside from the vol of baguettes, what else have you been watching in NASDAQ land?
It's creeping up, and I took a look at a few charts prior to coming on the air just to refresh myself with what's been going on. And the last time we did the show, we had 1 month realized volatility in the mid-10 handle, and we all commented on how difficult it would be to probably sustain such low levels. This is not implied, but the actual index volatility. And that 21-day moving average has, in fact, crept up, not to any tremendously high number, but to about 12.4, which is nonetheless almost 20% higher than when I last visited it 3 or 4 weeks ago. And interestingly enough, that 1 month average actually crossed the 3-month moving average, which had been up in around the 14 handle or so at the time that we were commenting on the 10 of the 21-day. And that 14 has actually started to come in slightly, so that 3-month volatility is now a little bit below the 1 month volatility. That can happen sometimes when the 3-month was harboring some data points from back in January and February that are now falling out of that average and causing it to actually cross and become lower. But what's really striking when you look at the graphs is we've got on our website 1 month, 3 month, and then 1 year worth of realized or real volatility of the index. And what's striking to look at is this tremendous gap, this incredible difference between the two averages that I've just discussed and then the 1 year. And the 1 year is incredibly at 23.19. So if you take a year's worth of data of NASDAQ volatility, it's over 23, whereas the 1 month and the 3 month averages are in basically the upper 11s and low 12s at the moment. So still a long way to go if you're looking for NASDAQ volatility to get back to more historically normal levels.
I wonder what that NASDAQ vol number looks like if you strip out Apple. That's been such a huge driver and component of NASDAQ for the past year or two. If you strip out Apple, I wonder what the actual realized vol of the rest of that index looks like. That might be an interesting comparison. I'm sure someone out there has done that.
Yeah, it's an interesting question, and we should know that because obviously it's a major component of the index, and it's obviously a rather volatile name. So NASDAQ X Apple might be an interesting number to look at.
Of course, it's almost, and from a vol perspective, it might actually be kind of boring because of late it's had one trajectory and one direction. So I guess from a realized vol perspective, of course, it is interesting, but still just all right. All right. And well, thank you for that, Don. That is going to do it for the old volatility review. And now we're going to dive right into our Volatility Viewpoint segment.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
All right, and welcome to the Volatility Viewpoint segment. This is the portion of the show where Don and I bring on a guest and pick his brain regarding volatility and all sorts of volatility trading topics. And today's guest is David Palmer. He is the Volatility Book Portfolio Manager over there at Hudson Bay Capital. David, welcome to the program.
Oh, thanks for having me.
We're mixing it up a little bit this week. We've had a nice run of interesting academics. Now we're bringing on some practitioners to keep our audience guessing.
All right.
So, and David, since this is your first appearance on the program and on the Options Insider Radio Network, we'll give you a chance to do what all of our first-time guests do and give our listeners a brief overview of your background in the derivatives business.
Terrific. Well, I have very good timing. I started in June of 1987 in an index option.
That was terrific.
Yeah, right. I mean, it literally 3 months later, I was learning what happened. How could I have such bad timing? But, I clerked on the floor of the American Stock Exchange for a wonderful firm called Investors Company. It was a joint venture between Spear Leeds and Ron Shear, and they gave me a great opportunity. And I watched one of the most amazing times I've seen. It's, probably just about the most amazing time I've ever seen in the option business, although there has been some recent, in the last 10 years, extreme stresses that have rivaled that. But, I got to clerk through the crash in the index option, and by December of 88, they put me on a seat so I could trade index options as a specialist, which required me to make liquid markets for clients and customers on the floor of the exchange. And I did that till 91, and I went out on my own in 91 and built a firm of derivatives market makers and specialists, and ended up selling the specialist business at the end of 05, and joined Hudson Bay in January of 07, doing just solely execution work for them. They had been in business for about a year officially as a hedge fund. Prior to that, they had been a prop shop, and I had known the owner, who was a friend of mine and a good guy. I had known him from 93 on the floor. We used to stand next to each other and trade options. And then they gave me a book in December of 08, trading volatility. And my role now, I've had a pretty varied career in volatility. Vast majority has been on exchange traded products. I've touched just about every exchange, from commodities to interest rate futures to listed equity indices, single stocks. And I joined when I started doing volatility portfolio for Hudson Bay. The goal had always been to try to find some embedded optionality in structures that weren't evident to others. So that's kind of my role now, is I'm trying to look for volatility that exists in a manner or form that is not classical. It's something that can be derived from something else and to have positive convexity in my portfolio.
That's certainly an interesting start to your career there. You must have thought 3 months in that your career was over before it had begun, with the market essentially being wiped out. Of course, that is an interesting introduction to the business from a volatility perspective, because you got to witness, in many senses, the birth of skew, or the birth of the realization of skew, I suppose you could say, as the fallout from the crash unfolded and people watched how things like downside puts in the SPX performed versus how they were believed to perform in those types of situations, and it unfolded a whole new world of possibilities for market makers out there. And we've all been struggling with it ever since to come to grips with it.
Right. It's interesting that you point that out, because a lot of people have forgotten that skew didn't always exist as we see it now. There were some very smart firms in the 80s who believed that there was downside risk that wasn't being priced properly, and they construct portfolios owning downside, and what would happen is the market would just keep going up. Now, that portfolio would certainly perform fine if you were hedged out in it. But you're right. In '87, I saw things that I haven't seen since, and I remember the great thing about being in the position I was in '87 was that I didn't have a position, so I could see all this with an unbiased eye as a clerk, and I watched the call skew flatten out, on 150 vol in the index, and I'd be looking at 5 or 6 strikes in the index that were all priced around $20. We're 150% out of the money. Yeah, they'd be 18.22, 17.5, 21.5, and they'd be 5 points apart, and they'd just be completely flat. It was the most bizarre thing.
That's something I think a lot of people today probably would have a hard time wrapping their heads around, is just how bizarre things got right in the immediate aftermath of that whole meltdown.
You had S&Ps moving, 40 handles on the opening 40 handles away, and the S&P was not a 1,300 point index at the time. It was much lower. It was a much larger percentage move, and you could not. There was no single price for a derivative that worked that wasn't astronomical.
I'd imagine there was a lot of arbitration in the wake of those days. I know we saw a lot of that stuff in the wake of the insane movements that we saw when I was out in the SPX back in the mid to late 90s into 2000 and the whole meltdown of 2001. And we had a lot of arbitration coming out of that. So I can imagine the '87 crash was far worse.
Yeah, it was interesting. There was a lot of arbitration that came out because people couldn't understand how they sold something for $2 that they paid $250 to buy back. And, when you sat down and you looked at it, when you're looking at it a year and a half or 2.5 years later, it looked excessive. But at the time, nobody knew what tomorrow brought, because we'd never, ever had a 25 standard deviation move like we had in the crash. Where do you sell risk?
Exactly.
Before we moved 25 standard deviations.
Common customer behavior is scramble to buy units and get whatever you can, then complain about the price after the fact. But it's funny, David, actually, in doing my due diligence to prepare for this show, as I am wont to do, your name didn't ring a bell at first to me, but apparently you and I have met, or at the very least, we shared a stage a couple years ago at what was it called? The iGlobal Volatility Forecasting and Trading Strategy Summit in New York. That's quite a mouthful. And apparently you and I were at the same speaking at the same conference. I don't recall bumping into you, but I'm sure we must have chatted. But it's interesting because that was I remember the conference because I ended up speaking on a panel about some of the topics about VIX and the way VIX at the time was being overhyped and overmarketed as a inverse portfolio hedge and a hedging instrument. And of course, Don, one of our former guests on the show, Henry Schwartz, was on the panel with us. We got into some of the other aspects like the downside puts in VIX and manipulation, all those kind of fun topics. But I remember shortly after that, after our panel concluded, there was a SIBO panel about how great the VIX was. So it was a very uncomfortable afternoon. I'm not sure if you recall that, David, but it was a fun one from my perspective. But while we're on the subject of VIX. I'm not sure if you've listened to any of our recent programs. We've had an interesting discussion / debate on this program of late surrounding the growing universe of ETPs that have sprung up around the VIX in recent years. You have these ETNs, you have ETFs, you have double levered products, you have, whatever the case may be, and how this universe of products is starting to feed back on itself and actually starting to manipulate the core product, the VIX itself, which is supposed to be this essentially the front month volatility of SPX. And yet now we have all these other masters that are coming in and perhaps overinflating the VIX relative to the realized vol of the S&P, or as we've seen dramatically of late, really dramatically impacting the futures term structure, or even just increasing the overall vol of VIX. So there's a lot of impacts I think we've seen and discussed, and how these products are feeding back into that. The TVIX is just the latest example of how these ETPs have kind of blown out of all proportion. Is this something you've been watching and something that you've been kind of trading into and out of yourself and commenting on this, how these products are starting to become the masters of the VIX in and of themselves, regardless of what the S&P is doing?
Thank you for reminding me of where I remember your name from, because I knew that I knew you, but I couldn't remember where I knew you from.
I have a face for radio. That's why, sir.
Yeah, I know. So do I. The VIX is a very interesting product, and this is my take on it. The VIX is a wonderful idea if you're an exchange and you want to market a product. It's very hard, I think, to truly educate the end user about what the VIX represents. Having said that, all these exchange-traded products that are kind of offshoots of the VIX are great ideas also. And I actually like a couple of the products. TVIX is one of them, and VXX is the other one that I like. And I've traded them a few times. They've come into a setup where it made a tremendous amount of sense for me to trade it, and I did. But the VIX itself is a very difficult product to justify unless you're very active in it. And I think a lot of retail investors see that and think of that as a product where they can get exposure to a hedge of some sort, or they want to trade it as an asset class. And it's much more than that. You really have to sit down, you really have to read the documentation, and you really have to understand the nature of the product. And I think you hit the nail on the head, because the term structure right now in VIX is, one would say, almost silly in the sense that it's just so, it's steep and it's really very, very high. As levels in the futures over where it's trading, and you see that transfers into correlation, which is the single stock volatility versus the index volatility. All this is now very tied together, and these ETF products will move around based upon really when you drill down to where all the single stock names are trading. And the recent activity in the TVIX was an amazing event for me, because I had actually bought some TVIX, which I am reluctant to do, because the optionality that is embedded in TVIX, you have to really be very, very good about timing if you're going to own the TVIX.
Yes.
You can't buy the TVIX as a replacement. You can't buy the TVIX, 20 shares of the TVIX and 80 shares of some mid-cap value fund and have a portfolio. You have to buy the TVIX very opportunistically, because it's all about timing, because the optionality will decay on you. But I had actually owned the TVIX when they stopped creating it. So I actually benefited from the premium that then existed in the product.
It was a good couple of weeks for you until and hope you got out before the implosion began.
Well, here's the thing that here's something that I have to say, and I hope the average investor or listens to this just takes this to heart, because this was a very public event. Credit Suisse announced, we're going to halt creations due to an internal limit. At that very moment, if you own TVIX, you realize a gain from the premium that exists instantaneously, because nobody's going to create it. So therefore, any demand will probably outstrip supply. And the demand had been rising into that, which is what caused the internal limits to be hit. So this is public information. If you own TVIX and you had a premium in it, you have an immediate negative expectancy for that product. So you must, if you're a rational investor, liquidate the position. Now, you might want to time it somewhat and say, well, I think there's $1 premium, but I think tomorrow can be $2. That's fine. But anybody who held on to it after that public information, was holding on to a negative expectancy trade. And that over long periods of time will bankrupt an investor. As soon as you knew there was a premium, you should have made a decision to get out. And one of the reasons why you should have made a decision to get out was because there was a lookalike product that you could have bought that had no premium to it, and that was the UVXY. The UVXY owned the exact same future structure that TVIX did. The difference between the two of them, and the reason that people like the TVIX, as well as I do, is it's guaranteed to have X% of the underlying index. Whereas the ETF, there can be some slippage through the pass-through, which is part of that. If you read the prospectus for both products, you'll read that one has pass-through risk for any slippage, rolling the futures, and the other can have pass-through risk because of their structure. But you could have liquidated your TVIX and bought UVXY and kept the same exposure with no premium. So, it behooves everyone to take a moment to read the news and to read the prospectuses of these different volatility products because they really give you an insight into what's going to happen when these events occur.
And of course, David, you didn't even have to own the TVIX because as a trader and seeing the potential for an arbitrage there, you could have obviously attempted to just lock in that premium. And classic sense of arbitrage is, selling and buying the exact same, ostensibly the exact same product, but at two different prices. So you could have sold TVIX and bought UVXY and actually established the position there. That certainly would have made a lot of sense also.
That's right. And, one of the things that you have to understand, and that's what a lot of people did. Ultimately, the TVIX premium would go to 90%. And there was a lot of people who entered into that trade who felt a tremendous amount of pain. You have to understand the structure, the nature of the products. You have to read the documentation. At the end of the day, TVIX never had to reopen. It is exchange traded note, and it's based upon the good faith and credit of Credit Suisse. It's not protected by any other service. So it's not an ETF. It's definitely not an ETF. Other people aren't allowed to create it. Only they're allowed to create it. They could have sold the rights to create it. They could have done something, but there's no guarantee that they would. And if you want to look at a product that's an ETN, a node, look at GAZ, G-A-Z. GAZ is a gas product, natural gas product that is issued by, one second, the IPAF Dow Jones
guys,
UBS Natural Gas Total Return Sub-Index, ETN. And currently the premium over NAV in that is 100%. And, if you take a product that's based upon certain structures, you can hit the limits of those structures and they never have to reopen. So it's a dicey proposition. And everybody looked at it like it was going to be free money. You had to be very careful about where you entered into those positions.
It's unfortunate. We do some of the other shows on this network. One of the ones we do is with a brokerage firm, and they have some relatively sophisticated customers on the retail end of the spectrum. And they said some of the customers that they're familiar with and they know are relatively sophisticated were just diving into the whole TVIX scenario without really understanding at all what was going on or how that product was really structured. And then they were getting the frantic calls a couple of days later, get me out, when everything was hitting the fan and those accounts were essentially decimated. So we did see a lot of people who should have known better. We see this with VIX. Obviously, people dive into that product without really understanding how it works, for example, the settlement process and everything like that. But once you get into these ETPs that are levered and float around the VIX universe, you really have to do even more homework to understand exactly how they're structured and exactly what you said, the optionality of these products, because these are derivative products, regardless of how they're structured, and you need to really understand how they work and how an event like that, where a massive flow of funds can completely disrupt how that product trades and cause it to disassociate from the NAV and become its own separate beast for several weeks. It was interesting. In fact, we've had some people on the show who've intimated in the past that the tinfoil hat crowd, I like to call them, that maybe the people behind VIXI or some of these other competing products may have been behind that flow of funds into TVIX in order to cause that exact scenario and cause people to flock into other similar products. Like I said, that's the tinfoil hat crowd, but we've heard a lot of that sort of speculation that someone had a nefarious means when they were flooding all of that money into TVIX in the final few weeks. I'm not sure how much stock I put in any of that, but interesting stuff nonetheless. Now, David, we talked a lot here about listed vol and listed vol products. But one of the reasons we wanted to bring you on the show was that you also trade a lot in the OTC realm. Well, actually, maybe that's a good starting point there. How would you break down your trading right now? What percentage would be quote unquote listed vol products versus the OTC variants and vol swaps?
The vast majority of what I do is in the listed space.
Really? Now, is that a recent phenomenon? Obviously, you come from the trading floor, so you have a lot of experience in the listed realm. But is that something where you've recently decided to migrate even more liquidity towards the floor and away from OTC? You know, we heard a lot of people talking after 08, 09 that, you know, people were going to be bringing their OTC trading to the floor. Is that something you did, or is that something you've pretty much always been a listed guy?
So when I got my seat in December of 08, it was at a time where many firms upstairs did not want to make reasonable volatility markets OTC. And the people that I called, if you wanted to trade, you know, S&P variants, you could still get a pretty good market. But, you know, away from that, anytime I was out quoting stuff, you know, I quote 2 asset, you know, binary options or something. And, you know, basically I would never get back a quote that I want to trade on. That has gotten better recently. Some firms have started to make better markets upstairs, but still what I'm finding is that the ability to monetize an OTC transaction is not as easy as the ability to monetize a listed transaction. And I'll tell you why. In the listed market, what's happening now, and this is kind of back to the TVIX. People piled into the TVIX. For whatever reason they piled into it, I don't know. I think sometimes it was ignorance. I think sometimes it was greed. But people piled into the TVIX, and it became a very crowded trade, and it became a very crowded trade at the wrong price. So as a volatility trader, I could access that wrong price if I want to. There are still, you know, and, you know, I can benefit by the fact that I know exactly what I'm getting because I can read a prospectus. In the OTC market, I don't quite get the same thing. What happens is I usually hear about the crowded trade when it's already crowded in the OTC space. And then it becomes a question whether I want to take the other side of the crowded trade or join the crowded trade for whatever reason. So the OTC space has been more challenging for me because I'm not as tied into it. I don't come from a sell-side desk that used to market OTC products. So I've been very, very judicious and very, very careful about even what I quote. And I just quoted something this week, and the market I got back was so wide that there was absolutely no way I would even negotiate going into that position. So I'm finding that being able to have the listing of an exchange or the ability to have the OCC back a trade and the ability to have, you know, prospectuses with the SEC, that I can still find things to do in the listed space where I know exactly what I'm getting for my dollars.
David, let me ask you a couple of questions. The first one is, given what you've just said, would you be a little bit intrigued by the idea of now having listed equivalents of volatility swaps in our realized volatility contracts, vol contract futures that are coming soon on the NASDAQ 100 and then hopefully on an array of underlyings after that? And might trading such products have a part or a place in your portfolio trading? And then as a follow-up to that, just my curiosity as to your day-to-day activities. When we talk about volatility trading, do you actually have pure portfolios of volatility products, whether they be arbitrage, one long, one short, different underlying assets, but pure volatility instruments? Or are you more involved in volatility overlays using the listed products in conjunction with whether it be equity or whatever the underlying might be as an overlay to the portfolio?
So to answer your last question first, I don't do volatility overlays against other portfolios, so to speak, like in the firm. Like part of my role is not to, you know, get long or short volatility against anything that Hudson Bay has. My mandate, as I understand it, and my mandate is the way that you know, that I run my book and like to run my book, is I'm always looking for volatility arbitrage opportunity. And then to talk about the first thing you mentioned, you know, there are some new products coming out via Volex, and I cannot wait for those to come out. I love those products.
Glad to hear it.
Yeah, one of the things that I'm really, really hoping is that I'm going to be able to access those markets and at least post my pricing into those markets, and hopefully there'll be some liquidity on the other side because, those products I think are very clean. They're very well known. There is no consideration about counterparty risk. There's no, it's a wonderful idea, and it's what I'm kind of, really hoping will come into fruition. And I hope that it trades. I'm really looking forward to it trading. That would be great.
You'll be happy to know, I won't list the names right now, but we have at a minimum of 4 very, very well-known, very prominent market makers who are going to be with us from day one, making markets, along with talking to several of the big investment banks to provide additional liquidity. So I think you're going to get your wish, and we'll be able to make good markets for you.
Yeah, that would be terrific. Now, in the middle part, you would ask me another question, kind of what is it, the structures that I look at, or do I look at pure volatility versus, long, short? And
yep.
My answer is that I'm always trying to recreate a structure from both the long and the short side from things that I can find in the listed space. So there might be a warrant on Ford, right? So Ford has a warrant on it. It's a nice little warrant. It's very cheap. You can buy essentially convexity fairly cheap in Ford. So if you have a short S&P vol book and take the delta out of it by hedging it out and have an embedded optionality against maybe the S&P 500, right, or some other sort of composite book that you might want to create a dirty dispersion book or something. So there's always kind of ways of looking at value that's not evident to other people, to build structures where you can be long and short vol and have a high expectation for a positive return.
So that, in essence, though, from what you've just described, that really is, and unless I misunderstood, an element of long short in the sense that you're looking for instruments where you've determined that volatility is relatively cheap, and you'd be happy to own them at that price, and then offsetting it, as you mentioned, let's say S&P, with short side volatility, which either is more traditionally priced or perhaps overvalued. And I don't know if that's making what you're doing too simplistic, but if you had a whole collection of instruments where vol was cheap against those where you're selling what looks to be a premium, that would be the start of a positive expectation trade or portfolio.
Certainly, that basically hits the nail on the head, right? The question, though, is it truly rich or is it truly cheap? And that's where the homework comes in.
Sure.
Is the downside put in the S&P 500 right now a sale against buying optionality through different means, or even just listed options in single stocks? If you do your homework and you look at the S&P 500 and you say, there's 30 companies here that I think people don't realize are going to miss earnings. And then you look and say, I think that the volatility in those stocks, half of those are very cheap. Now, you might do a top 50, which is the top 50 names in the S&P, plus 15 other names, and create a little bit of a dirty dispersion basket against the S&P. But then you have to look at where the S&P volatility is that you're looking to sell, because it may not be as overpriced as it kind of initially looks. So you have to know what's rich and what's cheap. And it's a lot of work. It's like crossing a very wide river that's not very deep.
And do you do this both ways too, David? Because now we're talking about, in essence, long and short volatility. Is there a delta component to it as well? Are you looking to get actually long and short from the actual delta perspective, certain names which wouldn't be as much a volatility component but a directional component? Or once you spot these things, are you doing straddles so that like everything is delta neutral?
Well, the goal is always to remove as much uncertainty out of the trade as possible, leaving only the thesis exposed. But I'll give you an example. Last spring in 11, I had some dispersion on, and it was very easy to sell. Correlation, very easy to sell, and it would never realize. So I very quickly closed that out, and we constantly are investigating every aspect of what's going on every macro front and everything else. And I came to the realization that volatility was just too cheap. Mm-hmm. It was just too cheap for all the questions that were out there in the world. So what we would have weekly meetings where we would literally drill down on every single thing that was in the news, find out whether it was valid or not. And I'd never been like an outright buyer with a bias of protection. And I turned to one of the partners in the spring and the summer of last year and said, I just basically want to buy volatility. Mm-hmm. I bought it in the index. I bought it on certain names in some financial sectors. Then it worked quite well. So, but that's the one-off trade. Normally, I'm looking for a rational arbitrage and remove all the excess risks that are associated with that.
Spoken like the true floor trader, where you're hesitant to dive in and buy vol. We're all trained to be degenerate premium sellers, as I like to jokingly refer to them. So those moments when you want to step up and actually say you want to buy vol or buy protection are few and far between. But I could certainly see you having some of those moments into late last summer, definitely.
There's enough questions last summer, and right now there are some questions that are out there. I haven't been able to justify this moment that I need to rush out and buy a massive amount of protection, even though absolute levels are cheap, they're still well above where they've been realizing.
Yeah, there certainly seems to be something hanging in the air. We discussed this on one of our other shows recently this week, too. Market makers are usually the first to take a holiday weekend out, and they'll start doing it on Wednesday or even Tuesday if they're really feeling aggressive. And this week, we didn't see that coming out even towards the close on Thursday night. People were still keeping their powder dry. Part of that was, of course, because we had a number on a day when the market was closed, so that probably threw a wrench into the works. But also, you're right, people have that feeling that there's something else lurking out there in the ether, waiting for that other shoe to drop, I suppose, or whatever the case may be. And people are hesitant to give away that weekend risk now for any sort of for a discount. They want to get a premium for giving away that weekend risk. So that in and of itself is a sign that people are starting to be perhaps a wee bit uncertain about the future here.
And part of that is that if you look at who has survived the last 5 years, it's been people who have been cautious and reserved in their risk taking. We had the flash crash, right? That was an incredibly strange day. That's one of the top 5 days in my memory. If you were just out there short gamma for some reason, just because you thought it was a good time to be short gamma in May, waiting for the summer, it was a very disturbing day.
Yes, I happen to have the good fortune or poor fortune to be actually having cigars with the risk manager of a very large trading firm that day. And we had just lit our cigars when all of a sudden we both looked at our phones and said, wow, that's odd. The Dow just dropped 100 points. And then it went quickly south from there. And I almost cost the poor fellow his job. Though in my defense, he did insist on having cigars with me, not the other way around. So it wasn't my fault that I dragged him out of the office.
Never turn down a cheap cigar, will you?
The worst day of all days for a risk manager to be out of the office. He somehow survived and kept his job. But since you mentioned, we are running a little long. We do have to get on with the rest of our show. But there are so many other things I do want to talk to you about. And since you did mention hedging and buying downside protection, I'll give you a chance to weigh in on one of our long-standing debates / discussions we have on the show before we go. We talk with a lot of our guests about the benefits and drawbacks of buying. Let's say if you're looking for that sort of protection, you're looking for that proverbial portfolio hedge, whatever the case may be. Are you more of a direct type of hedger? Let's say you have a broad-based portfolio. Would you want to go out and buy the S&P downside put, or would you be more one of these guys who leans in the volatility spectrum and perhaps would go with let's say a VIX upside call spread or something like that to hedge in the volatility sphere as well? Where do you fall in that direct versus indirect hedging debate?
There are times where the indirect trade is cheaper than the direct trade, but you have to be able to model that. So there is one of my favorite trades was in VXX last year, and what it was a short vol trade with almost no risk. Imagine that. And, that has not reappeared since then. And that was a better trade than doing the direct trade in the S&P 500. So it really is a matter of what you're trying to accomplish. If you wanted to take downside risk right now, one of the cheapest, and let's say you didn't have like a long dated view on it, one of the cheapest things that you could do is literally just buy at the money S&P calls and sell futures, because the absolute level of volatility is so cheap. And if we actually have a turn down of real significance, skew will flatten and levels will rise. So you won't lose as much on the calls that you thought you should based upon your hedge. You'll have no delta. You'll realize cash on the future move, and your calls may be very little changed on the day. So you can create structures depending on what your thesis is for what's going to happen to the marketplace. And you don't have to do the S&P 500. You can do sectors. I love sectors. Sectors are great because you can see rotation and everything else. So my answer is there is a price for everything at a certain time, and sometimes it's much cheaper to do the indirect trade than it is to do the direct trade.
David, that trade that you just described, were you creating simply a synthetic put and simply saying that the level of volatility was rather low, or was that a delta neutral trade where you were creating a cheap straddle so that whether we were down or up, you were getting what you felt was decent bang for your buck? Because if it was just calls kind of hedged one off with futures, so that was a synthetic long put, or what did you mean it to be delta neutral?
No, it would have been delta neutral. You were accurate when you said it much more like a straddle.
Right.
What I would have done was if I said to myself, I want to have a $250,000 or $1 million worth of risk, what is my actual thesis here? Am I 60% downside move of X percent and 10% upside move of Y percent? I would have known what the delta of the option was, but I may have hedged it dramatically different. So if it was a 30 delta call, I might have hedged it on a 50 delta, or I might have hedged it on a 10 delta.
Mm-hmm.
It all depends on what my, what I thought was going to unfold.
Well, that's the fun part of options. There's a hedge. 18 people could trade the same thing, and they could all hedge differently and all have all sorts of different fun outcomes. So there's many flavors for everyone out there. It's definitely the Baskin-Robbins of financial products.
It really is. Well said.
Well, David, we're glad we can bring you on the show today, and I know there's a lot more that Don and I wish we could chat with you about, but we do have to move on with the rest of the show. But before we go, we'll give you a chance to plug any upcoming events or appearances or anything else you might think might interest our audience.
Well, I don't have any to plug, to tell you the truth. My closing word to the audience is never be afraid to do your homework and read up on the products that you're trading, because there's always a wealth of information available to you, via the internet.
Well said, sir. I think a lot of our audience could certainly benefit from doing more homework, particularly on the retail side when they're diving into some of these very obscure and obtuse, multiply levered ETFs on some of these volatility products or ETPs. They really could use probably some additional homework before diving into those.
Yep. All right. Well, terrific. Thank you very much for having me.
Thank you, David. All right. And that's going to do it for our Volatility Viewpoint segment. And now we're going to dive right into our Crystal Ball segment.
And now we take a look at the crystal ball.
All right, and that somewhat haunting tune. We might need a more cheerful tune for the crystal ball. Of course, it does set the tone for the end of the show where people are relaxing. We're getting into the home stretch here. We're settling down a little bit. But in case this is your first episode, this is, of course, the portion of the show where Don and I peer into the murky ether of the future and attempt to divine what the vol gods hold in store for us today. And this is usually a part where Mark Sebastian rants about something going on in the future. I'll try to do my best Sebastian impersonation here when I look forward into the VIX. And actually, I don't see much to rant about from an S&P/VIX perspective in terms of the future. I think really we're in kind of our range where we're going to be for a while until we really hit the next unknown, to use a Donald Rumsfeld term. But we have this VIX has been in this VIX cash anyway has been in this range of 14 or so until about 17 for the past few weeks, and vacillating back and forth there. We're seeing the term structure come in a little bit, but I think there's a question as to how much that VIX term structure really can come in. And of course, there has been a little bit of realized vol over the past week or so in the S&P, but beyond that, over the past few weeks, there still is a significant premium between what we're seeing in the VIX and the VIX cash and the VIX futures and what we're seeing in the actual realized vol of the S&P 500. And of course, a lot of that can be traced back to what we discussed with our guest, David Palmer, that universe of ETPs that have sprung up around the S&P and around the VIX and kind of led to this situation where there are many other masters now plucking on the strings of the VIX aside from pure S&P volatility, which is one of the reasons why we have this inflated environment that we're in right now. But I certainly can see this settling in a little bit again, but probably not getting much below the 14 handle. And because we are coming up on the beginning of the quote-unquote summer doldrums, to use probably the most overused cliche of all, the sell in May and go away period, I could easily see us, Don, looking back at the vol views in September or October. So I should say looking ahead to the vol views in September and October and still having this same conversation. When are we going to break out of this 14 to 17 range in the VIX cash? Because we've been vacillating there for most of the summer doldrums. I could easily see this being the case for several months to come. What do you think, Don?
Well, I'm the last person on the face of the earth to predict higher levels of volatility, having been a seller of volatility in all of my trading days. But just looking at the current environment and what you said about sell in May and go away, I think many people know that there's a 6-month period in the equity markets, at least in the U.S. and the stock markets, starting with November and December, and then January, February, April, March and April, where the tremendous amount of movement in the market and historically, obviously, as we climb to the upside, has taken place. And a lot of the damage, if you will, or simply just not much movement, has then occurred in the next 6 months. There's some incredible statistics that unfortunately I can't just quote offhand, but if you take all the movement in the history of the Dow from when it was created and until now, up at the levels that we are, and you were just in it for the 6 months that I mentioned and out of it for the other time, I think you would actually have owned the vast majority of all of the upside movement in the index. And it's true for the S&P, of course, as well. So this is traditionally a period where you don't really expect a heck of a lot out of the stock market. And so, again, the concept that I mentioned earlier of the potential for lower equity prices, along with the fact that we're starting from such low levels of realized or actual volatility in the 10, 11, and 12 handles, which are historically so low for S&P and NASDAQ and for the Dow, that, I'd have to say if I were making predictions for actual levels of where realized volatility is going to be 1 month, 3 months, or even, 6 months down the road, I would say that we're going higher. Now, having said that, you might look at all of these implied vol products and say, well, you're too late to the party because it's priced in already. So the question
exactly.
is, we all probably agree that 10 might become 15 or 16 or even more, but that's where the VIX products are right now. So going out and buying them isn't exactly going to mean that you're going to have a layup here. So that's the other aspect of it.
Yes, exactly. That does pose a conundrum when you want to buy vol, but that premium is already built in somewhere, and then you're kind of left scratching your head because there's a dichotomy there to be had between realized and implied, but finding a way to accurately capture it is a more difficult prospect than it has been in years past. All right, Don, thank you for that. And that is going to do it for the Crystal Ball segment. That's also going to do it for this episode of Volatility Views. I, of course, want to thank our guest, David Palmer from Hudson Bay Capital, for joining us on the show today. A very, very interesting discussion. And last but not least, I certainly want to thank good old Don Schlesinger for making it back on the show. And Don, I know it's been a while, but what do you guys have cooking over in the land of volex.us that might intrigue our listening audience?
I actually wanted to make sure that I didn't miss anything, and I contacted our webmaster, Norm Wattenberger, who does just a fabulous job on the volex.us website, and I said, can you give me a quick rundown in the last month or so of some of our new bells and whistles or improvements or additions or anything that's been done at the website? And he was kind enough to point out a few items to me that I might not have gotten around to. They aren't major changes, but we've completely redesigned the very page on which you'll find all of the radio episodes that we have done together. And so there's now a synopsis of each one that's kind of embedded that you can click on, and they're listed according to the reverse order with a guest list easily seen for all the guests that we've had. So you can kind of peruse the list, and if a name jumps out at you, go ahead and listen to that particular one. So the way in which we display kind of accordion style with synopses and direct access to the various program topics have been greatly improved on the site.
And listeners, I don't mean to jump in, Don, but listeners, if you want to find that on the Volex US site, because it isn't right there on the homepage, jump on to volex.us, then click on the News tab on the left-hand side of the page, and you'll see in that pop-out menu there, the third one down is Volex on the radio. You click on that, and then you'll see this new page that Don is describing with all of the guests. It really is a great way to list it, because you can see, you can break out by guest, break out by topic, see a synopsis of the program. It really is an interesting way to display the radio.
And finally, on that home page or the main page, when you first log on, we've displayed some of the frequently asked questions, the FAQ, in a slightly different manner that makes it a little bit more accessible, along with all of our real vol or realized volatility historical indices that are now displayed on the front page. You get commodities, you get rates, you get FX, you get equity indices, all very easily accessible and displayed. So we're trying to make access to volatility information not only as thorough as possible, but as easy to follow and navigate as we can on the website. So we invite everybody to go take a look at volex.us and have a look around.
Well, speaking of making access to volatility information easier and also tweaking access to the radio, many of you have asked us to make volatility views available on the Stitcher radio service. Many of you will know that is a very popular streaming audio service that is available across on the web and across many smartphone and tablet ecosystems. Well, as of late last week, we are now a content provider on Stitcher, so you can find the full gamut of Options Insider radio shows, including volatility views, by going to Stitcher.com and searching for it there, or probably most of you will download the mobile app to your tablet or to your iPhone or Android phone, and then you could stream volatility views and have Don in your ear everywhere you go throughout the day. So
perish the thought.
Yes, exactly. So now you can stream us via Stitcher. You can, of course, as always, find us and subscribe to us on iTunes. You can find us on that very new and interesting volex.us radio page, and of course the mothership, the optionsinsider.com, where we can check out all of the Options Insider Radio Network programming there in our digital overlay. So there's many ways for you to get to access the show, so for your listening pleasure. So, of course, we want to thank all of you out there for downloading and streaming and subscribing to this program and making it such a success. And we'll see you next week right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volex.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volx Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.